Welcome back to the deep dive. Today, our mission, well, it's pretty straightforward. We're looking at a stock market that's delivered almost unbelievable returns.
Mhm.
Since those bear market lows back in October 2022, the S&P 500, it's clocked an 80% total return. Just a phenomenal surge.
Yeah, it really has been. I mean, huge gains in 2023, 2024, and, carrying right on into this year.
Absolutely.
But those really eye-popping returns, they've pushed the overall valuation metrics into, well, let's just say historically rare territory.
Right.
We're now in a spot where the entire S&P 500, on paper at least, looks historically expensive.
And that's really the critical starting point for our deep dive today, isn't it? Because the classic valuation signs we look at, they are giving us some pretty stark warnings.
They absolutely are. I mean, we've seen the CPE ratio that's the cyclically adjusted PE sale past 40.
Wow. 40.
Yeah, and just for context, that's only happened one other time in history.
Yeah.
That was right before the dot-com bubble burst.
Not exactly comforting history.
Not really, no.
Mm-hmm.
And the standard forward PE for the index, it's sitting north of 22. And then you look at something like the Buffett Indicator.
Comparing market cap to GDP.
Exactly. That one's also hitting an all-time high. So the message from these big picture metrics, it's loud and clear. The broad market seems to be pricing in, well, perfection.
Okay, which is exactly why this next point really throws a curveball into the whole thing.
Yeah.
We've got Bill Nygren, veteran manager over at Oakmark Capital.
Yep, know well.
And he's essentially kind of shrugging off these, frankly, terrifying headline numbers. He's arguing that despite this historic run-up, despite these elevated valuations, there are just as many appealing, undervalued opportunities in the S&P 500 today as there were, say, 7 years ago, back when the index actually looked, reasonably priced.
And that paradox right there,
Yeah.
that's the focus for our whole discussion. How can the S&P 500 be historically expensive and at the same time offer a really robust hunting ground for a fundamental value investor?
So, okay, let's unpack that. We need to understand the mechanism here. What's driving that overall headline price? What structural change has happened in the S&P 500 that might be causing the index valuation to, well, maybe lie to us a bit?
It really boils down to one thing, the concentration effect. The index just isn't a broad representation of 500 big companies weighted sort of equally anymore.
It's changed.
It's become fundamentally skewed by just a handful of, well, tech behemoths.
Can you give us some numbers on what that concentration actually looks like?
Sure, if you look at data tracked by folks like Yardeni Research, they focus on the mega cap 8. The names Apple, Microsoft, Alphabet, Amazon, NVIDIA, a couple of others.
The usual suspect.
Pretty much. So this group, back in 2018, they were maybe 15% of the S&P 500's total market cap.
Okay.
Today, it's roughly 33%, a third of the index. And if you zoom out just a bit to the top 10 companies overall, they now account for nearly 40% of the index's total value.
40% from just 10 companies.
Exactly. So a massive chunk of the index's performance, and therefore its overall valuation, is dictated by just 2% of the companies in it.
And crucially, those top stocks, they're overwhelmingly high-growth tech companies, right? I remember seeing Howard Marks comment on this.
Yes, the legendary investor. He pointed out something really specific about this group,
What was that?
that they've largely earned their high valuations. They've demonstrated extraordinary earnings, extraordinary growth, which actually supports their high prices, at least for now.
Okay. So it's not that they're necessarily bubbles waiting to pop.
Well, that's the subtlety many people miss. The immediate concern isn't necessarily that the top 10 are fundamentally overpriced relative to their own growth. The concern, Marx points out, is that their sheer massive weight has dragged the overall valuation of the entire S&P 500 into record territory.
Okay, I see.
And the real problem, as Marx notes, is that many, many other stocks have kind of followed the market momentum. Their prices have gone up,
Right.
despite the fact that they are not producing those same staggering growth rates we see at the very top.
Got it. So if the index looks expensive, mainly because of that top layer, that 40% block, then theoretically, the other 60% of the index, the other, 490 stocks, they could be reasonably priced or maybe even cheap. And this is the argument for the value investor.
Precisely. And this is exactly where Bill Nygren comes back in with his most, well, I think it's a fascinating statistic. It defines this whole environment.
Okay, what did he say?
He noted, and I'm quoting here, even though the market has gone in the past 7 years from an upper teens multiple to a mid-20s multiple, 7 years ago, there were about 150 stocks under 14 times earnings. Today, there are about 150 stocks under 14 times earnings.
Wow. Okay, hold on. That's That's more than just a statistic. That feels like the entire deep dive right there in one sentence.
Kind of sums it up, doesn't it?
Yeah. It suggests that while the average PE of the index has skyrocketed, the actual number of stocks trading in what many would call value territory under 14 times earnings hasn't changed at all.
Exactly. The price concentration has created this massive polarization in the market.
Right.
It really shows that the traditional idea of market efficiency, where all information is priced in equally across the board, that seems to be breaking down a bit because of this concentrated wealth effect.
So there's this whole group of stocks left behind.
Yeah, there's now this large group, this cohort of individual stocks, where the market is just heavily discounting their future earnings. Often it's because of worries about the macroeconomy, or maybe they're cyclical, or there are sector-specific fears.
But wait a second, isn't the market usually, kind of right? If there are 150 companies trading at such a low multiple, how does a value manager like Nygren tell the difference between a genuine bargain, a true value stock, and a value trap? A company that's cheap for a very good reason and likely to stay cheap.
Well, that's the entire art, isn't it? The art of fundamental value investing, especially in a market that looks like this, so polarized. For Nygren, his strategy, what they call the Oakmark way, it really hinges on two core principles when looking at these discounted companies.
Okay, what are they?
First, they absolutely must be growing shareholder value over time. You need to see rising free cash flow, rising earnings. They can't just be cheap and, stagnant.
Makes sense, need some growth potential.
Right. And second, they have to have management that is demonstrably acting in the shareholders' best interests. Using capital effectively, maybe through smart acquisitions or returning capital via buybacks or dividends, good stewardship.
So the job for the successful investor then is to sift through that list of 150 cheap-looking stocks and figure out, is the market applying a temporary discount, maybe something cyclical or emotional, or does this company actually face a permanent structural problem?
Exactly right. You're hunting for mispricings driven by temporary fear, not fundamental permanent decline.
Okay, let's shift this from the theory to the actual practice. Let's look at where Nygren is putting his money right now. We can use the Oakmark U.S. Large Cap ETF, ticker OAKM, as a window.
Good idea.
What stands out immediately is just how wildly different this portfolio looks compared to the S&P 500 index it's benchmarked against.
Oh, the divergence is profound. I mean, you look at the S&P 500 today, it's super heavily weighted toward information technology.
Yeah, tech is huge.
Nygren, conversely, has this massive conviction weight in financial stocks. As of the end of June, financials made up almost 40% of the Oakmark portfolio.
40%. Wow, that is a staggering commitment to just one sector, especially one that's, faced some recent headwinds.
It is. It absolutely is. But it really speaks to the depth of the opportunity he believes exists within that hidden 150 list we talked about.
So what's the thinking there?
Well, think back to the banking turmoil in 2023. After Silicon Valley Bank collapsed and there was that whole regional bank scare.
Oh, yeah, I remember that period well. Lots of anxiety about commercial real estate exposure, duration risk on bond portfolios.
Right, exactly. And that panic, that fear, it created what Nygren saw as a temporary but very deep discount across the sector.
Okay.
At that time, many solid financial stocks were trading at multiples around half that of the overall S&P 500 index.
Half. That's a big gap.
Huge gap. Historically, financials usually trade closer to maybe two-thirds the average PE for the index, reflecting their inherent cyclicality.
So Nygren basically saw this temporary fear-driven gap between the historical norm and the fire sale prices being offered.
That seems to be the thesis, yes. And even though financials have bounced back quite a bit since then, that massive 40% weighting, which includes big positions in names like Citigroup, Charles Schwab, Bank of America, Capital One, and Financial, it strongly suggests Nygren still believes the discount is significant enough to warrant this really aggressive positioning.
What does he see there specifically?
He likely sees stable, even growing, cash flows, improving balance sheets, and management teams committed to shareholder return, all treating at a fraction of the cost compared to those concentrated tech leaders at the top of the index.
Okay, so on one hand, we have this really big tilt towards traditional, historically discounted value sectors, like financials. But what's genuinely fascinating, I think, is that Nygren doesn't just dismiss the expensive end of the market entirely. He's not just buying banks.
No. And this is a really important nuance. It's what separates perhaps brilliant stock picking from just rigidly adhering to simple value rules.
Right.
If you look inside that Oakmark fund, the single largest position, accounting for more than 6% of the entire fund, It's Alphabet.
Well,
Both the GOG and GOGL share classes.
Alphabet. Okay, that is interesting. That's quite a statement, putting such a large allocation into a company that, on the surface, trades at a premium PE ratio, over 24 times forward earnings. How does a deep value investor rationalize making a growth giant like Google his top holding?
Yeah, it seems counterintuitive at first glance. But it comes down to what's often called sum of the parts valuation approach.
Sum of the parts, meaning you value each piece separately.
Exactly. Nygren argues that the market is basically failing to accurately price Alphabet's secondary assets, the things outside its core search and cloud businesses. And because of that, the market is significantly undervaluing the core business itself.
Okay, let's break that down. What are these secondary assets that investors are apparently discounting so heavily in Alphabet?
Well, the first big category is the other bets segment. This is the stuff like Waymo, their autonomous driving unit, Verily in life sciences, various other deep tech long-term projects.
Right, the moonshots, which are successful in innovation, maybe, but they lose a lot of money currently.
Precisely. It's essentially like a venture capital portfolio housed inside a public company.
Yeah.
And the market tends to apply zero or sometimes even negative value to these segments because they burn cash and the payoff horizon is just so far out, so uncertain.
So analysts basically ignore them or treat them as a drag.
That's often the case, yeah. They might discount the value of other bets to zero, or sometimes they'll even subtract the operating losses from the core search segment's profits, which mathematically makes the overall valuation multiple look higher, look more expensive.
Okay. What else besides other bets?
The other huge piece is the massive pile of cash on Alphabet's balance sheet. Nygren views that cash as a guaranteed asset, almost like a bond holding within the company. But a simple forward PE ratio doesn't fully or accurately account for that huge cash position sitting there.
Ah, I see. So if you do the Nygren calculation, so to speak,
Yeah.
you strip out the value of those external assets like other bets, you properly account for the cash pile, and then you look at the core search and cloud businesses. That headline PE of 24 for the whole company suddenly looks much, much lower for the actual underlying profitable operations.
That's the argument. It becomes a classic value play, just dressed up in a high-tech uniform. The value proposition isn't necessarily based on predicting Alphabet will grow another 50% next year.
Right.
Instead, the value is realized if or when the market eventually recognizes the latent value in those secondary assets, or perhaps if those businesses are eventually spun off or become profitable. It shows that true value investing requires looking past just the ticker symbol and the headline multiple and really analyzing the component parts.
That shift in perspective is definitely key. So wrapping this up, what does this all mean for you, the individual investor, trying to navigate this, well, kind of strange market environment?
Yeah, I think the key takeaway is just recognizing how bifurcated, how polarized the market really is right now. While those headline numbers, the KPE ratio, the high overall PE, they do suggest the market is historically expensive. That expense is driven almost entirely by the extreme concentration of wealth and the very high valuations assigned to maybe just the top 10 companies.
And that concentration, that skew, has actually created this massive opportunity space for sharp fundamental value investors. Is that fair to say?
I think it is. Opportunities seem to exist in sectors that have been, perhaps unfairly, discounted due to recent events or cyclical fears like the financials that Nygren has targeted so aggressively.
Right.
And interestingly, opportunities might even exist within certain big tech giants themselves, like Alphabet, where you have these underlying assets or venture segments that the broader market seems to be heavily undervaluing right now.
So managers like Nygren and Howard Marks, too, they're essentially confirming that this current market, despite the scary headlines, actually presents ample opportunities for active stock pickers to potentially outperform the index.
Yes, provided they're willing to do the deep fundamental research and look beyond just that top layer, beyond the mega cap names dominating the returns.
And, that leads us perfectly into our final thought for you to consider today. In a market this highly concentrated, where just 10 stocks dictate almost 40% of the S&P 500's performance, is simply tracking the index still the best or even the most representative measure of value and wealth creation out there?
That's a really good question.
Or perhaps, must investors now be willing to look past the dazzling performance of the Megacap 8 and actively hunt for value among those, say, hidden 150 companies Nygren talks about in order to truly succeed in what might be a new investment paradigm?
Something definitely worth mulling over.
Absolutely. Something to think about until our next deep dive.